I thought it'd be helpful just to do a recap of changes that have happened. I think it's fair to say landlords have faced quite a few changes in recent years, and looking forward at tax changes that we know are coming as well. Always like to try and start on a positive. It's not always easy with tax, because I think, as lots of you will know, there's been lots of changes which haven't resulted in better positions for you. So I've gone back to April 2016 when they introduced the replacement of domestic items rules. Now, this was really welcomed for people that let their properties unfurnished, because it was quite hard to get relief for goods, sort of like your white goods that would always still be in the property. But this really extended it, and you now get relief when you replace an item. So the initial spend you don't get relief for, but when you replace it, you will get full tax relief in your income tax computation. So that was a good change. Next up is mortgage interest relief. Anybody that's got mortgages on their properties will know that this was not a welcome change. If you're higher rate taxpayers, you only now get your 20% tax relief as a credit in your income tax computation. And that really has hit the tax liabilities for a lot of landlords. The next was April 2020, and that was the reporting for capital gains tax. So normally you would have to pay any capital gains tax, report it on your normal self-assessment tax returns. This rule was introduced, and now if you sell your property, have a tax liability, you have 60 days to actually file and pay that tax. I'm pleased to say they have listened to professionals, because it was 30 days, and that was really challenging for people. They sell their property and literally have 30 days to sort out, pay their tax and understand what their liabilities are. So again, it's making sure that they're aware of this and plan in advance, because it's much better if you've already worked out and know what your capital gains tax liability is going to be before you've sold your property. Also at that time, they changed the rules where you may have a property in your portfolio that was once your main residence, and then you've maybe moved and decided to keep that and that quite often is the start of your rental portfolio. You used to get something called lettings relief. So when you came to sell that property in the future, you would have a much better overall position. They've taken that away. Lettings relief is now really available in really restricted circumstances. So it saw overnight people's capital gains tax liabilities on those specific properties really rocketing. So again, it's something people aren't always aware of. So next is this year, April 24, it was a welcome change. So a few years ago, they changed it. So if you sold residential property, you had to pay higher rates of capital gains tax. That came down from 28% to 24% for higher rate taxpayers. It remains at 18% for any gains that fall in your basic rate band. So again, they really do differentiate between any other kind of asset and a residential property. They put these higher rates in. But at the same time, they reduced your annual exemption. So normally, in the past, we've had over £12,000 of gains that weren't taxable. Now that's come down to £3,000. So what's still to come? We have the most anticipated autumn budget coming up on the 30th of October. Sadly, I don't have a crystal ball. I get asked a lot as to what I expect. I think what is widely expected is that we will see changes around the capital taxes, so capital gains tax rates, inheritance tax. A plug on the screen, we as a firm will be doing a live webinar the day after the budget. It's free. Anybody can sign up via the QR code or on our website. We have got the QR code on our stand outside if anybody is interested. What we do know is coming is in April 25. If anybody's got properties in their portfolio that they let on short-term lets, so furnished holiday lets or Airbnbs, they used to get preferential tax rules. They've been abolished from April 25. Again, we've done a webinar on the changes which are available on our website. We've got a brochure on our stand, so won't go in the details today. But if you do operate in that market, then it's certainly worthwhile just making sure that you are aware of what's coming. And then making tax digital. This has been something that has been talked about for a long, long time. It kept getting deferred. I once said in an internal presentation, it won't be deferred again, and it was deferred again. So, but I honestly think it's coming now. So April 26, if you have a turnover over 50,000, you'll be caught. That limit drops to 30,000 from April 27. And what it means is that you need to file quarterly returns, keep digital records. So it's an additional administration burden for landlords. We're happy to talk to you about it. There's different software packages out there that will help, that have got other added benefits as well. So we'd be happy to talk through those implications. Next, I've just picked a couple of topics which I think we talk to our clients a lot about. The next one is sometimes frustrations where people think they've done something and they haven't quite done it right in terms of HMRC's views, and so therefore they don't get the benefit straight away. So it's just really flagging, so it's all on your radar. And that's where married couples own property together. So it doesn't matter what percentage you own that property. If you don't do anything, you will automatically be taxed 50-50 between you. But quite often a husband and wife will have different other sources of income, and maybe you want to try and arrange your affairs in a better way to minimise income tax liabilities. So you might look to want to share profits in a different proportion. That can be done, but you need to make sure that you've changed your beneficial ownership in that property. So lawyers, such as Foster's, will be able to do something called a declaration of trust. So typically we will see sometimes clients will have that 99% for one, 1% for the other. So they can make sure that they're getting their best sort of income tax position as a family unit. That's fine, but there has to be a report goes into HMRC on a Form 17. And that's only effective from the date that it's signed, and you have 60 days to submit that. And you have to send your declaration of trust alongside it. So some people don't always realise the default happens unless this form goes into HMRC, and they don't then get the treatment that they want. It's also worth noting you can only do it if you own the properties as tenants in common, not joint tenants. So again, you might need lawyers involved if that's not how you currently legally own the property. So I say the Form 17 allows you to move away from that default 50-50, needs to go into HMRC, and I say it really can give you that favourable tax position from an income tax, but it also just needs to be bear in mind your other taxes to make sure it is the right thing. You are giving over, a further interest in that property. Next, business structures. Based on the discussions I've already had with people today, this is definitely the area that I get the most questions about. And the one, especially when we've got budgets come in that people are worried about, everybody is always questioning, am I owning my property portfolio in the most tax efficient way? The first thing I'd say, there is no right or wrong answer. I'd also put a health warning out there. There are people out there that are marketing schemes that will help you get from being a personal ownership into a company. They don't work. There is no right answer. There is nothing you can package up and go, this is right for me. So just be really careful. Make sure that you get good tax advice, that somebody that really has understood your personal position to make sure that you're making the right decisions. So in terms of, thought it helpful just to do an overview, because lots of people say, should it be personal? Should it be a company? First of all, mortgage interest, that's a tick towards a company. You will get full relief before you have to pay your corporation tax liabilities for mortgage interest. Whereas in your personal ownership now, we've seen with those changes, you only get the basic rate tax credit. Tax rates on personal, it'll be 20, 40, 45, depending on your level of income. A company will be 19, 25, or somewhere in between. So again, depending on your levels of income, often a company is more attractive. In terms of tax rates on your gains, personal 18 or 24, company 19 or 25. So that's quite similar. One bit that really is key is extraction. So if you need that rental income to live off, if it's in your personal ownership, you've already paid your tax on it, you're free to go and spend it. If it's sat in a company, you then need to get it out of the company. So then you could be looking at salaries or dividends. That's another layer of tax. So that's again why I say it really is fact specific, because some people will say, actually, I'm just happy for it to roll up in my company, whereas others are saying, no, I need that to support my living. Interest rates, that's not for me to comment on. Charlie will be able to comment. But again, if you're thinking about it, make sure you're involving your mortgage advisor, because it will be different if you've got a mortgage in your own name compared to a mortgage in a company's name. So again, it's just making sure that you understand getting the advice in that area. If you've got properties that you want to spend time in, so again, sort of holiday lets, for example, if it's in your personal ownership, that's a lot easier to manage in terms of restriction of any costs. If it sits in a company, you've got benefit in kind, employment tax issues. So again, if you want to spend any time, it's probably a no to a company structure. Then ATED, in tax, we love an acronym. So that is the annual tax on enveloped dwellings. If you own it personally, you don't need to worry about it. If it's in a company and the property is worth over 500,000, you could have tax liabilities, but at the very least, you'll have forms that you need to do and exemptions to claim. So it's just, again, additional red tape. And then finally, stamp duty land tax. Personal ownership, you'll have a 3% premium. In a company, you'll also have a 3% premium. But if it's a really expensive, over £500,000 property, you could have a 15% surcharge. So hopefully that gives you a feel that there's quite a lot of different taxes in play and things that need to be considered to work out what is the best structure for you. I guess the other thing is it's much easier to get the structure right when you're first starting out as a landlord. It's much harder to switch from personal ownership into a company, because at that switch it will trigger tax liabilities as well. So it would be an event for capital gains tax purposes. So if your properties have gone up in value, you could be triggering a tax liability unless we can get incorporation relief. And that's quite hard to achieve. It's interesting when Paul was talking earlier about you all being business owners. HMRC don't really see it like that. They see rental as investments. So it's a really hard test to say it's a business to get incorporation relief. An example, you would personally have to spend 20 hours a week is one of the factors, which some of you probably do, others maybe not. So again, it's depending on the size of your portfolios. If you've got letting agents involved, it's really harder to satisfy those tests. Stamp duty, if you move it from personal ownership into a company, it will trigger stamp duty unless you're operating and moving from a partnership into a company. There are exemptions. And so I would just, again, a health warning on anti-avoidance rules. Again, some people say, oh, that's fine, have it in your personal ownership, then we'll just set up a partnership and then we'll go into a company. If you've really put just a step in the middle to get that relief, you're at risk of, the anti-abuse rules kicking in. There needs to be some substance to that partnership, some commercial reasons. It has to have some longevity, partnership returns, partnership agreement. So again, it's not just easy tick box to satisfy. And I guess finally, just a plug, just get good tax advice. There is no right or wrong, but it's just making sure that you get the advice, get the right structure for you. Looking at your long-term plans, I've been talking to people this morning, succession, inheritance tax, what are you going to do with your portfolio in the future? All considerations that you should be looking at as you're making sort of immediate decisions as well. So I am around all day, we'll be in the workshop this afternoon, so I'm sure somebody will ask me for my budget predictions before I get away today. So thanks for listening.
Thank you ever so much.